Gold is camped near record highs. Silver's at a 14-year peak, and miners have followed as markets bet the Fed will ease despite those latest August consumer inflation figures ticking up. Investors are weighing rate cuts against tariff-driven price pressures and uneven industrial demand from copper to platinum. Well, to help us make sense of what matters for portfolios right now, we're joined by Daniel Ghali, Senior Commodities Strategist at TD Securities. Daniel, once again, thanks very much indeed for your time.
Yeah, absolutely. Thanks for having me.
Listen, I want to start with how U.S. inflation is setting the tone for markets, right? We've just seen consumer inflation here coming in higher, 2.9%. There's a sense that a rate cut is still expected next week, though. What's the cleaner driver here for gold? I mean, is it policy easing odds or safe haven flows? What's your take?
Yeah, that's interesting. And I absolutely agree. The Fed is on track to ease over the coming weeks and potentially several times this year as they shift to the second part of their mandate, which is, of course, the labor market. The labor market is showing some signs of weakening, but it's very obscure. And it's very obscure because the immigration policies in the United States and the resulting implications for labor market participation are in flux. That means that the market doesn't really know if the labor market is weakening as a function of demand for labor, or is this really a supply of labor story? So the outlook is actually quite muddled, but nonetheless, the Fed is going to be cautious and cut interest rates. Well, and what does that mean for gold? Well, clearly lower interest rates reduce the carry costs for holding gold. This is typically associated with higher gold prices, but to some extent you can make the argument that a lot of that is already priced in, and unless we see a dramatic shift in Fed interest rate implications going forward, then gold markets may have run ahead of this topic.
Daniel, against that backdrop, right, we've sat just below new record highs for days. What would you watch for a break higher or a sharp pullback over the next couple of weeks?
It's interesting, Devin. I think that what most market observers are not focused on right now is the state of market volatility. Right, market volatility has been compressing for many months consecutively, and that with that backdrop in mind, many of the market's favorite trades, including gold and silver, are now vulnerable to an increase in volatility. I say that because quant funds, which are some of the dominant players in commodities markets in particular, are now exposed on several fronts, including their return engines, meaning that all trend signals that they can devise are already pointing to the upside, which lowers the scope for them to continue to buy. And the leverage that they employ is already nearing common sense caps. Both these things have been exacerbated by the compression in volatility of the last several months. And so all they really need to sell from this point forward is an uptick in volatility, some kind of surprise on an event risk.
It's interesting you say that. I just took a look at a new TSX 30 report, which shows gold miners dominating the list of top performers, right? Not surprising, but is this a structural shift for Canadian miners or just a cyclical run-up? How do you see it?
Well, I think it just underscores the strength in gold prices, right? This is a secular bull market in gold that is underscored by a broad variety of factors, each of which provides some diversification to one another, right? So in this particular month, central bank buying activity probably wasn't the main driver. The main driver of higher prices was probably increased speculative appetite. Zoom out, a few months ago, that clearly was not the story. Macro funds in particular were dramatically under owning gold, and central banks were the main story here. So that pull and push from different factors, all of which are bullish for gold, have supported this secular bull market. And although we're tactically cautious around the prospect of a pause in the bull market, we remain bullish from a strategic perspective.
Silver's near a 14-year high, Daniel. Is this a momentum spillover from gold, or are we just seeing improving industrial fabrication underpinnings here that keep it supported?
It's not. It's not a gold story, actually. Silver has an exceptionally strong idiosyncratic story The main fundamental argument at this moment in time is the scarcity of freely available silver in London vaults. Right, mind you that London is the epicenter of over-the-counter trading when it comes to gold and silver markets and other precious metals. The US is the epicenter of futures trading. Those two epicenters once in a while come into conflict, and this is one of those times. That conflict is underscored by the prospect of tariffs in the United States. Right, silver is the only precious metal for which the market does not have absolute clarity that it will not be tariffed, particularly with the upcoming Section 232 investigations, and that there will not be an exit ramp as there may be for others such as platinum and palladium. So with that prospect in mind, the market has been draining inventories from London, moving those inventories into the United States in an attempt to get ahead of that. And the rub here is that London inventories are already well below the critical thresholds for the market structure. Right? We estimate less than 150 million ounces of silver are freely available for purchase in London, but 250 million ounces trades on any given day over the long run. So that tells you there really is a scarcity problem with respect to silver, and the only cure for that are higher prices.
Daniel, I want to wrap up with what's been happening with copper. Copper's hovering near $10,000 as China output signals wobble and tariff dynamics churn trade flows. Now, does that argue for consolidation or a fresh leg higher into year end? What's your near-term line in the sand here?
Well, a break north of $10,000 a ton is quite difficult for copper. And it's difficult because it raises the prospect of substitution. Right? This is a theme that is increasingly coming up in our client conversations. And what they're asking is, what is the price at which, or the premium at which copper versus aluminum substitution starts to make sense, right? We think we are well above that level. There are some signs of technological innovations that have supported a substitution of copper in favor of aluminum. But that will take time before it really starts to impact copper demand. So I think the next leg higher is more difficult. Most of the run that we've had is a function of stockpiling both in the United States and in China. And it's unclear when that stockpiling impulse is going to ease.
Daniel Ghali from TD Securities, always a pleasure. Thanks indeed.
Thank you so much, Devin.